Welcome to vTalkInsight, Risk Sentiment Daily for March 31st, 2026. An escalating Middle East energy shock is colliding with renewed growth fears, pushing volatility higher and forcing portfolios back into defensive mode. Let's unpack how this shift is reshaping risk sentiment across equities, bonds, currencies, and commodities. Risk sentiment today is best described as defensive risk-off. The S&P 500 has slipped again, extending a multi-week losing streak and leaving the index back in correction territory, while volatility sits in the low 30s. Flows are rotating toward perceived safety, with global government bonds rallying and the US dollar acting as the primary haven, even as traditional hedges like gold and large-cap technology have struggled to provide consistent protection. The backdrop is dominated by escalating conflict in the Middle East and a severe energy supply shock, which are driving record monthly gains in Brent crude and sharp moves across related commodities. Compared with the brief, cautiously risk-on tone late last week when oil prices dipped, the renewed surge in crude and shipping disruptions has pushed portfolios back toward de-risking, tighter hedging, and a greater focus on tail risks rather than incremental carry. The Middle East energy shock and disruptions are the core bearish driver today. Physical crude supply losses are estimated at around 11 to 12 million barrels per day, with key flows through the Strait of Hormuz and Red Sea increasingly impaired by attacks and military escalation. Brent has surged toward $116 a barrel, up about 60% this month in a record rally, while analysts talk openly about scenarios where prices push into the $150 to $200 range if infrastructure damage deepens. Shipping risks compound the shock. Houthi involvement and broader regional tensions are disrupting Red Sea routes, threatening Saudi exports and forcing vessels onto longer, costlier paths, while strikes on alternative hubs like the UAE's Fujairah port fan anxiety about secure outlets. Official reassurances about higher tanker flows look largely symbolic against an estimated daily shortfall near 9 million barrels, and early signs of physical shortages in parts of Asia underline how tight the system has become. This shock is feeding through into higher energy volatility, record gains for oil majors and refiners, and mounting pressure on energy importers and fuel-sensitive sectors worldwide. A ceasefire or a credible deal to protect energy infrastructure could eventually deflate the geopolitical premium and validate more benign forward pricing, and history shows markets often look through geopolitical shocks once stability returns, but current evidence still points to an underpriced and persistent disruption. Rising stagflation risk and policy limits form the second major headwind. Oil above $100 is estimated to add around 0.5 to 0.7 of a percentage point to U.S. inflation, while diesel at more than $5.50 a gallon is biting hard for producers, farmers, and transport-heavy industries. In Europe, regional German data point to month-on-month price acceleration, with German inflation expected near 3% and Eurozone forecasts jumping from roughly 1.9% to about 2.6% for March. Central banks are caught between still elevated inflation and softening growth. Market and household expectations remain above the 2% targets, and officials worry that repeated energy shocks could unanchor those expectations if they persist. At the same time, policymakers know that reacting too aggressively to supply-driven price spikes risks tightening into a slowdown, so the default stance is a cautious pause, limited willingness to cut, and a focus on monitoring whether today's energy shock spills over into broader and more persistent inflation. Policy options to contain energy prices now look constrained. Strategic reserve releases are only marginally offsetting a supply deficit estimated in the low double-digit millions of barrels per day, and commentators argue that only a durable ceasefire or credible protection deal for energy infrastructure would meaningfully ease prices. That limited toolkit, combined with already stretched fiscal positions, raises the probability of a period where growth slows, inflation remains uncomfortable, and central banks have less room to smooth the cycle than in previous crises, even though some officials still project inflation drifting back toward target over a multi-year horizon if hostilities fade. Growth slowdown fears and an equity correction are the third key bearish driver. Global government bonds have staged a strong rally, with the U.S. 10-year yield dropping toward 4.4% and 2- and 10-year benchmarks closing near recent lows, signaling a pronounced flight to safety. Major bond managers and institutions such as the OECD and IMF are warning that markets may be underestimating the risk that the Iran conflict and energy shock drag global growth lower from here. Equity markets are already reflecting that shift. The S&P 500 has logged 5 consecutive weeks of losses, is down roughly 9% from its high, and has re-entered correction territory, while emerging market equities are off around 10% in March, and some emerging currencies have fallen more than 5%. Valuations in the U.S. have compressed from about 28 times to roughly 21 times forward earnings, yet remain above a long-run average near 18.5, leaving room for further downside if growth and earnings expectations deteriorate. Positioning and credit dynamics add nuance. Hedge fund exposure to U.S. equities shows signs of capitulation, and selling has finally reached leading momentum names in areas like memory chips, consistent with a later phase of the drawdown, while private credit faces scrutiny over leverage, liquidity, and redemption pressures. Countering that, private credit default rates remain low, emerging market fiscal positions and reserves are stronger than in past crises, and U.S. growth is still seen running above 2% for now, suggesting a slowdown risk rather than an already embedded hard landing narrative. On the bullish side, rising Fed rate cut expectations are beginning to provide a counterweight. As attention shifts from pure inflation fear toward the risk of weaker growth, pricing in short-dated rates has moved toward more cuts over the coming year, and yields have fallen across U.S. Treasuries, Japanese government bonds, and other core markets. Large bond managers are positioning for lower yields, seeing scope for a rebound in high-quality duration if geopolitical risks further undermine growth and keep investors seeking safety. For now, the Federal Reserve is signaling an extended pause rather than imminent easing. Officials see a high bar for renewed hikes thanks to softer labor conditions and lower inflation than in 2022, but also want more evidence before committing to cuts. Commentary from policymakers indicates that if the conflict's economic fallout were to weigh more heavily on activity and the labor market, it could give the Fed justification to lower rates later this year, a conditional easing option that markets increasingly factor into risk assessments. Lower yields matter because they ease some pressure on valuations, reduce funding costs at the margin, and support traditional safe assets that can help stabilize multi-asset portfolios. The key risk to this bullish rate cut narrative is that persistent energy-driven inflation or an unanchoring of expectations forces the Fed and peers to stay on hold longer, or even lean slightly more hawkish. So upcoming inflation data and growth indicators will be critical for gauging whether this emerging support can gain traction. Energy and commodity equity outperformance is another important bullish driver amid the broader risk-off tone. Brent's roughly 60% monthly surge and prices above $115 have translated into double-digit gains for energy stocks, with S&P refiners up more than 20% in March. Major oil companies in the U.S., such as Exxon and Chevron, and in Europe, including BP, Shell, and Total, have all materially outperformed their domestic indices as investors reward cash flow leverage to higher crude. Industrial metals linked to the region are seeing similar dynamics. Aluminum prices spiked on smelter attacks in Bahrain and the UAE, lifting producers like Alcoa and Century Aluminum by 7 to 8%, while broader basic resources strength has helped indices such as the FTSE 100 outperform despite geopolitical stress. These moves highlight that even in a risk-off environment, capital is actively rotating toward sectors with direct pricing power and tangible exposure to supply disruptions. This sectoral rotation creates significant performance dispersion within equities, benefiting energy and materials at the expense of consumer discretionary, durables, and some staples that suffer from higher input and fuel costs. There are limits to the story, as extreme price spikes can trigger demand destruction and incentivize new supply, capping medium-term upside. But for now, energy and commodity producers remain one of the clearest places where the current shock is being priced as an earnings positive rather than a macro threat. Supportive fiscal policy and backstops provide a third, more structural, bullish element. In the U.S., fiscal policy is already adding meaningfully to growth through tax incentives and deregulation that encourage capital spending, particularly among small and mid-sized businesses. On top of that, a new fiscal package of around $200 billion is being prepared, combining higher defense outlays with domestic stimulus measures that could include a temporary suspension of the federal gas tax and targeted support for vulnerable sectors. Globally, G7 countries have signaled a willingness to step in if energy market dislocations deepen, offering at least some confidence that official backstops would be deployed in a severe disruption scenario. However, concerns about fiscal deficits, a partial U.S. government shutdown, and legislative gridlock raise questions about how fast and how forcefully support can be delivered. So while policy remains a cushion against worst-case outcomes, it is not a full offset to the current combination of energy, inflation, and growth risks. For portfolios, this mix of ongoing fiscal support and constrained monetary flexibility points toward a macro regime where nominal growth is supported, but inflation risk premia and term premia may stay higher than in the pre-crisis decade. That backdrop can favor real assets and quality balance sheets, while making it more important to differentiate between regions and sectors that benefit from public spending and those that are more exposed to higher borrowing costs and potential policy fatigue. To sum up, today's risk sentiment is defensively risk-off, driven by a severe Middle East energy shock, rising stagflation concerns, and mounting worries about a global growth slowdown and equity correction. Against that, markets are beginning to price more scope for rate cuts. Energy and commodity producers are clear relative winners, and fiscal policy plus official backstops are helping to limit, though not remove, downside risks. From here, the path of the conflict, incoming inflation and growth data, and signals from central banks and fiscal authorities will be key in determining whether this risk-off phase deepens or gives way to a stabilization phase. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.